Good afternoon. It's Jonny Haycock from von Greyerz. It's an honour to have Alasdair Macleod back on for another edition of Gold Sessions. It's hard to know where to start, Alasdair. There is so much going on in the world, and I'm trying to be disciplined to sort of frame the discussion for 20-25 minutes to sort of three areas. But when I think about the last time we spoke, which was just before Christmas, which feels like an age away, gold and silver prices have rocketed up, and events geopolitically have taken center stage. But I want to try and focus on three areas: the bond market, the acceleration in de-dollarization, and then get into the plumbing of what's going on in the gold and silver market specifically, if that's all right.
Yeah.
Perfect. Well, let's just start with the bond market. Whilst everyone had their eyes on Davos last week, I have to say my focus was on what was going on in Japan and the long end of the JGBs, the 40-year at 4%. And I know you've written a lot about the debt market. Could you just give us your insights into what you think investors should be really very, very closely paying attention to now in the bond market today?
Yeah, I think the overall background, Jonny, is one of bond markets as a whole being less stable than they were perhaps yesterday or the month before or the year before. And so I think what we're seeing cracks in the bond market facade beginning to sort of run, if you like, through the whole system. And these cracks are sort of getting quite wide in some areas, which where they should be getting wide. The situation in Japan is really extraordinary. The Japanese government and the central bank are thoroughly Keynesian in their approach. In other words, they believe in using credit to stimulate the economy all the time. And the result is that in a nation of savers, you have this extraordinary situation where the government has been able to get away, and the central bank obviously, to get away with printing an awful lot of yen credit, if you like. For what purpose? Really, for not really very much purpose. But the thing that's allowed them to do it is the high savings rate, because savers, when they receive these extra yen, tend to save a goodly portion of them, which means that doesn't go into consumption, which means that prices are generally more subdued than they would be, say, in Europe or UK or, dare I say, America. And the consequence of that is that they've been getting away with it, if you like, with this crazy system for so long that now that they've got a debt to GDP, which is estimated about 230%, something like that, we now find that actually the underlying inflation rate has been understated. I mean, we do know that the government, for example, has subsidized a lot of transportation costs and things like that, which has had the effect of suppressing the apparent rate of inflation. It's actually quite a bit higher than where it is, officially anyway. So I think this is something that's beginning to fall apart. And if you look at the balance sheet of the JGB, sorry, not the JGB, the Bank of Japan, because they've got something like 60% of the 10-year JGBs on their balance sheet, and bearing in mind that yields have risen from negative figures at the time of COVID to currently we're looking at 2.3%, something like that. I mean, the losses that are hidden on the Bank of Japan's balance sheet is just absolutely astronomical. Now, everybody says, "Oh, this is not a problem because they can always print their way out of trouble." But hold on a minute, print their way out of trouble from here? I don't think so. So, what you have, I think, is the cracks are beginning to appear around the world. And Japan is one of the places where this is happening. And of course, this then morphs into problems for other bond markets. I mean, the Japanese institutions have been buying US Treasuries. They're collectively, the pension funds and insurance companies, the largest foreign holders of US Treasuries. As their bond yields rise in relative terms, US Treasury yields become less attractive. So that is a problem. On top of that, of course, you've got the carry trade, which uses very, very low Japanese borrowing costs in order to leverage up into the higher yields, say, even of US T-bills. So all that is, if you like, threatened. All that begins to unravel as the problems in the Japanese bond market evolve.
So should we expect yield curve control then, Alasdair, and institutions that have had all these savings and money invested in international assets, particularly US assets, that money gets repatriated back home to high yielding JGBs, and then could that be the canary in the coal mine to actually crack the US stock market?
Well, I think it is. I mean, if not directly, then indirectly. When it comes to yield curve control, I don't think that can be done in these circumstances at all.
Right.
What effectively we have is what used to be called in the gilt market a buyer's strike, which really I think is a pretty bad way of putting it. But effectively, there's no demand at current yields on the long end, and this hasn't been tested. If you're going away from Japan, going into US Treasuries, it hasn't been tested along the US Treasury yield curve because all the funding has been done short term. The gilt market is slightly better off insofar as we've got a longer maturity profile, so we don't have to roll quite so much debt over year to year. And for some reason, hedge funds are very happy to buy gilts, to the extent that even the Bank of England gets a bit sort of wary about all this interest coming from US hedge funds, and sort of thinking, well, if they turn sellers, we got a problem. Yeah, he's dead right. But so you can see that there are all sorts of things which are just basically wrong in the international bond market. And as to the point, there is this very genuine fear that as the JGB market, the Japanese government bond market, destabilizes, this is going to have a knock-on effect on everybody.
Yeah. And so you'd agree that maybe Japan is possibly the canary in the coal mine. I mean, we've talked about the UK, clearly that is, soaked in debt, similar with France, but Japan seems to be the market where we may get proper cracks that could unravel elsewhere. Would you agree with that?
It's certainly possible, but it's not the only source of disruption in these markets. I think that the political situation over Greenland, for example, got a number of, particularly the Danes. I mean, the Danes don't have an awful lot of US Treasuries, but saying we're going to sell these things. I guess also that other European nations, insofar as where governments actually have any influence on this, are probably not buyers. It's interesting that most of the buying of US Treasuries, and I think this must be understood, is really done by US entities offshore. I mean, you've got the Cayman Islands, which is the center for the captive insurance industry. Now, a lot of US hedge funds also use the Cayman Islands for their offshore activities. So they will do their, borrowing in yen to pick up the yield on US T-bills through their Cayman Island subsidiaries. As well as that, as I understand it, there are American interests which have been, if you like, taking money in Luxembourg, offering a yield which is superior to what you might get, let us say, in the bond market, and applying that to US Treasuries. So again, these are basically American interests replacing quite a lot of the overseas interest, which is recorded in the US Treasury's tick figures. So the position is actually quite complex. I think where the Japanese thing will probably come in is really as this carry trade unwinds. I mean, interestingly, the new Japanese prime minister seems to be very, very much on side with the Americans, more so than her predecessor, who was sort of edging towards the Chinese, as it were. So, it's going to be interesting. But I think quite a lot of the problems we have at the moment really are originate, if you like, in America.
Yeah, so, which brings me on really to the second point, Alasdair, because look, since we did our last interview, we've had Venezuela, we've had Greenland, we've had obviously Davos and some inflammatory comments there.
Yeah.
And it just seems that with every passing day, new tariffs, et cetera, that trust in the system is eroding. And when a system loses integrity, then is it not as simple as just money moves away? And the de-dollarization that's been in place for some time, of course, seems to be accelerating given Trump's foreign policy and rhetoric. Is that fair?
I think that is fair. And there is another aspect to this, and that is essentially geopolitical. The Monroe Doctrine, basically, of America controlling everything in the Americas, north, south, and central, and also presumably Greenland, is being brought in, if you like, by Trump. And I think that's very much at the behest of the deep state, the CIA, and those various other planners, if you like, in the background. But what this does is it effectively gives a signal to the Deep South, all the rest of the world, if you like, that America's interest in them is diminishing.
Yeah.
And therefore, they will be freer, if you like, from the regime change threats and all these other things that the Americans have used to keep order and to keep their power going around the world. So I think that's what that's done is it's released, I think, a lot of dollars from central bank reserves all around the world, which are now surplus to requirements. And at the same time, China has opened up its SIPS, its non-dollar settlement system, to basically all comers. And I think this was very much in the wake of Venezuela, because there are substantial investments in Venezuela made by the Chinese.
Yes.
And what Trump has done is basically he's trashed all those investments. I don't think we've heard the end of it, but I think what it's doing is it's alerting the whole of Asia in particular to America is no longer a worry for us. Okay, they might go and bomb Iran or whatever, but I mean, this. Other than that, we're now on our own, and we've got to work with China and Russia rather than worry, looking over our shoulder at America. It's the pressure has been relieved, I think, to an extent by that very, very move. The Monroe, or what some detractors are calling the Donroe Doctrine, I think it actually has that effect. And I don't think we've heard the end of the Venezuela problem because of the massive investments that China has made in Venezuela. It's, the oil out of Venezuela is a small part of China's total consumption, but, it's been stolen. I mean, there's the only way to put it. So you can see that I think China is now in the position where it doesn't actually mind if the dollar collapses. Now, that's a very, very big statement. It really is. I think they see it as inevitable anyway. But as that feeling gathers momentum throughout, particularly the East Asian continent, I think that you'll find that selling of dollars is just going to, escalate. And I think that's part of why we're seeing the gold price rising. It's not so much the gold price rising, it's just people getting the hell out of the dollar.
Yeah, and you're right. I mean, gold and silver are reflecting this move away from the dollar, and indeed other commodities as well, of course,
Yeah.
are doing very well. This sort of paradigm shift from financial assets to hard assets,
Yeah.
that certainly at Von Greyerz we think is a multi-year phenomenon. But I want to just get on to the last point about gold and silver specifically, because you've been excellent, Alasdair, as advising your subscribers on gold and silver and showing them the open interest on both gold and silver, and very, very regularly. And what's always struck me with silver in particular, that as it sits in between sound money and industry, it's a rather unique moment at the moment. With silver, the open interest has been remarkably low, despite a soaring price. Is that still the case?
It's still the case. I mean, there's been a little bit of a pickup, if you like, in open interest in the last few trading sessions, which when you see the price go up, sort of 10% a day, several days in a row, you would expect a few punters to say, hold on a minute, we better have some of this. But it's very, very minimal. And I mean, the thing that's fascinating about it is that essentially the problem is an industrial one. It's not a monetary one as far as silver is concerned. Down the road, that is likely to happen. But at the moment, it's really big industries who have, if you like, relied on deliveries out of the market for their silver, are suddenly finding there's none there. And for some time, they've been buying, let's say, futures with an idea of just taking delivery on expiry, or in London, buying forward contracts and again insisting on delivery rather than cancelling out another position by selling the forward contract into the market. So this has come as a bit of a crisis. And it's come at an interesting juncture because, again, China is very much involved in this. China has brought in a new licensing regime for silver exports. Now, the information that we have is that so far this hasn't really kicked in too much. But you can see that, the objective of this is to give China, if you like, greater control over something which, as a nation, they feel they really do need. Silver is so important.
Yes.
China is something like the second or third largest miner. As well as that, for decades, she's been importing doré and refining that into silver and hoarding the silver. So she has got undeclared stocks which are substantial. Of that, I have absolutely no doubt. I mean, it's circumstantial evidence, but on the other hand, you just, join the dots and you can see that this is the case. I think the price exploded upwards, really, on the back of Donald Trump's trying to, if you like, tariff China, which led to China saying, okay, that's your game. You're not getting any rare earths. So that was the first thing. And of course, silver is a much needed commodity, which it's not a rare earth, but in that definition, but it's not that common. So it's something which it's more in China's interest to hold on to now than to supply into the market in order to keep prices low, so that her industrial entities making photovoltaics, making electric cars and all the rest of it, sort of are competitive. That is no longer the situation.
Yes.
And it happened at a time when Indian demand has taken off, because the Indian government, which, while it's been sort of building, coal-fired power stations and doing all these horrid things, has been, if you like, offsetting it to a degree by encouraging major corporations like Reliance Industries to make photovoltaic cells. And they've been subsidized to an extent to do it. So, the investment that Reliance Industries, and I'm sure there are others, have made in production are just absolutely astronomical. But where do they get the silver? And I think that they have been one of the gangs, if you like, that have been standing for delivery in financial markets. It's a fascinating situation, and it's a problem that is not going away. And I think, we could easily see silver being squeezed up even further, but not producing sellers. If anything, producing buyers on the squeeze. In other words, the squeeze is not over. It's got quite a way to go.
And we have to remember, of course, that if we inflation adjust the price back to where we were in 1980, when it peaked at $50, I think the numbers are you get to $200 quite comfortably just to get back to that inflation adjusted level. So despite the move, there is a hell of a long way to go, and that's before you start thinking about the gold-silver ratio, which we spend a lot of time at Von Greyerz thinking about at the moment in response to clients wondering, should we be selling a little bit of silver and reallocating back into gold? But our message is, look, the gold-silver ratio has collapsed from 100 to 50, but you go back over a long period of time, you can easily see, well, back in 2011, it got to 30. And beyond that, you get down to 15. So our message is just hold on to it. It's got a lot further to go.
Yeah. No, I'd agree with that. And I think there is a general point behind this, which very few people understand. And that is the consequence of fiat currencies has been to suppress the real value of base metals, the metals used in industry. Now, copper is another example. You see how the copper price has behaved. It has actually risen quite sharply. Obviously not as much as silver and some of the platinum group metals, but nonetheless, if you look at the value of these base metals in gold, then you can see that the price of a basket, if you like, has fallen by roughly 80% from that long-term average. Now, monetary theory tells us that actually the purchasing power of gold is stable over long periods of time. So with it, with everything else, all the other base metals being 20%, if you like, at 20% of their long-term value, you can see that even in gold terms, the values of these metals, they're going to change upwards very, very substantially. So you've got the basis of a substantial bull market, if you like, in base metals. The result of their suppression, basically, by fiat currencies. Now, with the fiat currencies going down against gold as well, I mean, the place to be if you really want to diversify out of gold is in some of these base metals. And I think this sort of squeeze is really being reflected in particularly silver and also the platinum group metals. We're seeing it a bit in copper as well. And I think it's generally a very, very bullish story for commodities, because it's not just base metals. It goes wider into raw materials and also agri-products and all the rest of it. The knock-on effect of that, of course, is that we will have unexpected inflation in 2026. I would think probably from about the middle of the year, you will see prices starting to rise very substantially. I think this is something which is not expected. Nobody's talking about it. All they're talking about is, well, Trump's going to get interest rates down, so this is wonderful. Come on.
And if what you say is right, and I think you absolutely are right, Alasdair, then something that you and I've talked about before, that your traditional portfolio, the 60-40 portfolio, is just not set up for this.
No.
At all.
No.
And there's going to be quite a shock, to come as that inflation comes through. Portfolios just aren't protected for it.
Listen, it's an interesting point, actually, because this 60-40 thing is something that was really dreamt up by regulators. But if you actually think in terms of risk, where is the risk? Well, the risk is being in credit.
Yeah, absolutely.
So, I mean, it doesn't matter whether it's bonds, equities, or an IOU from someone else, whatever. It really doesn't matter. The thing is that the way in which you control your risk is you get into real money, which legally is gold and historically silver. So, what else do you do? That is the zero risk position. And I think that more and more people are going to wake up to this in the coming months. I think it's going to be as soon as that. I mean, I really do.
I couldn't agree more, Alasdair. I mean, 2026 is already shaping up to be quite a year. And we've got another 11 months to go. But listen, we're out of time. I want to keep this snappy. As ever, thank you so much for your insights. We love your work, and we're very grateful to you being an advisor to Von Greyerz. And I look forward to seeing you very soon. Thanks so much.
Well, it's very much my pleasure. Thank you for having me on, Jonny.